Imagine that you're building a house with just a hammer, only a hammer. Now, you might get some nails in the roof, maybe be able to hang some walls, but when it comes to plumbing or cutting the wood, it's just not going to happen. Well, you wouldn't use just a hammer to build your home. You're going to need a lot of different tools, saws, levels, ladders, power equipment, and so on. Well, the same goes true when it comes to building retirement income. Relying on just one tool, that might get the job partially done. What if using a few more tools could give you more income with less stress and a lot more peace of mind? In this video, I'm going to demonstrate an income plan that created 3 times more income to spend in retirement. I recently met a couple and I shared with them how combining multiple tools like a dividend strategy or guaranteed income annuities and growth accounts actually created a better outcome. I'm talking 3 times more reliable income that they can spend in retirement. Here's the problem, and I hear it all the time. What if we run out of money or we live too long? Maybe the market crashes when you retire. Many people rely on a one-tool market-driven approach. But one event like COVID or the housing market decline that happened in 2008, a bad experience, assisted living, or maybe even premature death of a spouse, well, that can change everything. When it comes to optimizing retirement income, ideally you want to have your money in 2 out of these 3 boxes. One of them is yield. Yield is like dividend stocks, bonds, and bond ladders. They're instruments that provide yield on your capital. The other is guaranteed income. Now, these instruments create income floors and gives you money on a month-in, month-out basis. Social Security, which is backed by the government, company pensions backed by the assets of the company, and then guaranteed income annuities that are backed by the claims paying ability of an insurance company. And then finally, there's passive income. Passive income is like real estate investment income, rental income that you get on a month-in, month-out basis. Now, research has shown that using a combination of these tools with a growth strategy creates better, more reliable outcomes in retirement. So let's meet Mark and Lisa. They want to retire near the beach, they want to travel, and they also want to help their grandkids' education. But the most important thing is they want to ensure that they never worry about running out of money. They want to generate as much income as possible that's reliable, simple, and consistent. They're both age 55 and they plan on retiring at 67. They have about $1 million that they want to invest in a dividend portfolio. They like dividends. And the reason why they like dividends is because it allows their money to grow and also provides income at the same time. I didn't disagree with them, but they saw a video that I did on the importance of using different tools to optimize income in the safest, most reliable way possible. A dividend portfolio is good, but you may be asking the portfolio to do a lot. You want it to grow, you want to provide income. Somewhere along the way, it's going to sacrifice something. For the one-tool approach, and because Mark and Lisa were dividend-focused, I'm going to use the Invesco S&P 500 High Dividend Low Volatility ETF, and that symbol is SPHD. What is the Invesco S&P 500 High Dividend ETF? Well, it's based on the S&P 500 Low Volatility, so not a lot of movement, high dividend, more yield index. The fund will invest at least 90% of its total assets in common stocks that comprise of the index, and Standard & Poor's compiles and they calculate the index. And it's going to be composed of the 50 securities that are traded on the S&P 500 index that historically have provided high dividend yields and low volatility. So using this historic data, if you invested $1 million in the SPHD, and that was in April of 2013 to June of 2025, that $1 million with dividends being reinvested would grow to just over $2 million. At age 67 in June of 2025, assuming a 3.5% yield, they would generate around $71,000 a year in income, and that's not bad at all. That's really good. But there are pros and cons to using just dividends. Dividends aren't guaranteed. Companies can cut them, and many have. But there are also companies that have raised them, and you can see you're still getting growth from that account. For the optimized strategy, we're going to use different income tools. Now, one thing you need to know about financial tools, from cash and CDs, annuities, bonds, life insurance, mutual funds, stocks, real estate, crypto, all of these are attributes, and each of these attributes are designed to solve a problem. By using a different combination of tools, you're taking less pressure for that tool to perform. The importance of using tools to optimize income is a more balanced approach using multiple income tools. And what we're going to do is we're going to split $1 million 3 ways. We're going to take $300,000 and we're going to put that in a fixed index annuity that provided a lifetime of guaranteed income on benefits that's backed by the claims paying ability of an insurance company. Then we're going to take the remaining balance and we're going to split it into long-term growth positions. $350,000 is going to go into the SPY ETF, and that stands for the SPDR or S&P 500. And this is a really popular exchange-traded fund that tracks the performance of the Standard & Poor's 500 index. It really allows investors to gain a lot of exposure to the U.S. stock market because it represents the 500 largest publicly traded companies in the market today. So the SPY is one of the largest and most liquid ETFs, making it a really, really popular choice for both long-term investors and active traders. The other part of the money, we're going to put that in the Invesco QQQ ETF. Now, this tracks the NASDAQ 100 index. It gives you access to the performance of the 100 largest non-financial companies that are listed on the NASDAQ. So companies like NVIDIA, Google, Facebook, that's what you'll typically see, more tech-oriented. Now, the growth from the combination of these tools from, once again, April to June of 2025, well, that resulted in just about $3.8 million. But here's where it gets a lot more interesting. The income from the annuity, the account growth was only about $412,000. Remember, we started out with $300,000, and now it's worth around $400,000, assuming just about a 4% growth rate. But the income generated off that was $48,000 for the rest of their lives. Then what we did is we took the difference between the growth portfolio of the SPDRs and the QQQ, and we subtracted that from the growth of the dividend portfolio. That resulted in about $1.3 million. We said, let's put that in another annuity that gave them more income. How much would that generate? Well, that generated around $92,000 a year. So that's almost $140,000 of guaranteed income for the rest of both of their lives. All right. Now, what can we do with the remaining part of the portfolio? Well, you can do a lot of different things. If the goal is income, you can do the 4% rule. You can turn that into a dividend portfolio, and that's what we're going to do here. We're going to move that into a dividend portfolio. You can let it grow if that's what you want to do, but just for apples to apples comparison, if we took that money and we put it in a dividend portfolio, what would that yield? Well, it would yield about $71,000 a year. So the total income by using a multi-tool approach was around $212,000. That's almost 3 times more than the single dividend-only approach. So let's compare the two. The one-tool dividend-only approach gave Mark and Lisa around $71,000 to $72,000 a year. None of it is guaranteed. The multi-tool approach provided guaranteed income of around $140,000 for the rest of both Mark and Lisa's life. They never have to worry about that part running out of money. And they still have another part of the portfolio that can generate income. So the total potential is around $210,000, which is going to give them a lot of flexibility and reliability, both of which is what Mark and Lisa really wanted in retirement. The bottom line is this. Using multiple tools is going to give you a lot more options. It's a lot less pressure on each tool to perform. When you have your money in different income tools, it can provide better or more optimized solutions when it comes to your overall retirement picture. So, how do you optimize income using a multi-tool approach, and what's the benefits? Well, one of the benefits is it provides more stability. The other is it can optimize your income, gives you potentially lower risk, and it also allows the rest of your portfolio to grow long term, which helps you keep ahead of inflation. This is an example of what Mark and Lisa would have experienced over the last 12 years if they utilized this multi-tool approach. Now, right now, we don't know what's going to happen in the markets. Investing in the markets, it has risk. It's possible to experience better or worse performance, and this would impact the value of the holdings and future income. That's the importance of using a multi-tool approach to help fortify your retirement. When you start thinking about Mark and Lisa, they're walking on the beach, playing with the grandkids. They're laughing at the cafe out in France. It's not just about how much you make. It's about how secure it makes you feel. It's about creating reliable income in the safest, most consistent way possible. By using the right matrix of tools, Mark and Lisa didn't just build a plan. They helped build a future to live their dream lifestyle. And they can do it potentially with 3 times more income. If you want to explore how to optimize your retirement income with less risk and more reliability, diversify your assets and diversify the tools that you're using. Now, if you need some help, there's a link below. I'd love to be able to help out. And if you like this video, like and subscribe to this channel. Throw in some comments, because that's going to help me learn what you're thinking, and it's going to help me create content to help you retire with confidence. Thanks for watching.